Okay, good morning. Limited companies, lesson possibly 2 or 3. You've done document 371. You've done a couple of questions with Darren. Now we're looking at the issue of shares. Before we do that, let's look at the bottom half of a statement of financial position. Okay, so how is this company financed? Well, they've raised shares, ordinary issued shares. Share premium, well, from document 371, you'll know that's related to shares when you sell shares above the nominal value. Again, another term you need to know from document 371. Revaluation reserve. A revaluation reserve, again, document 371. It's a simple one to understand and remember. It's when the value of your non-current assets go up in value, you increase the top half of the statement of financial position, and you also increase the bottom half of the financial statement of financial position to restore the balance. Okay, so that's when your non-current assets have gone up in value. In this case, you can see from the 31st December 2020, or the other way around, let's say, 31st December 2019, within a year, they've increased in value, they've doubled in value by $500,000. And finally, you've got your retained earnings. And your retained earnings are a reference to your net profit, but it's a bit more than that, a bit more complicated than that. But essentially, it's your profit that you've kept in the business. That's after your taxes and after your dividends. After your taxes and after your dividends. Now, some of you are very proactive, very good learners. You probably started copying this down. You may have even heard that I mentioned a kind of a title here. We're talking about issuing shares. Issuing shares. So you might have put that as your title. I've just explained this. This is an extract of a statement of financial position, and we lovingly call it the bottom half. Half for limited companies comprises the capital and reserves and retained earnings. We've had a quick look at what all these mean. I would reiterate it again, I think. We're comparing 2 years from December 19 up to December 2020, so 1 year. So let's just go through these lines very quickly again. In 1 year, we've increased our capital from our shareholders by issuing additional shares. We've doubled it. We've raised £3 million. Now, we don't know where we spent that because we can't see the top half of the statement of financial position. Perhaps it was on extra machinery, motor vehicles, inventory, etc. And some of it's sitting in the bank. We've also managed to increase our share premium, and that was as a result of issuing shares at greater than 50p. 50p represents a nominal value. Nominal value is the face value or the par value, and that represents the price of the shares when the company was initially set up. But now that the company has grown in size, when they sell shares for greater than the nominal value, but we don't put that figure in this line, ordinary issued shares. We'll put it in a separate line, so we know how much we're getting in terms of the increase in the market price of the share from the nominal value to the market price. That's the second line. Third line is really easy. Increase in value of non-current assets. Very often in questions it's a building. Okay, buildings or premises. So the top half of the balance sheet would have gone up by $500,000 to get to from $500,000 to $1 million, and the bottom half, obviously, to restore the balance from the top half and the bottom half of the balance sheet, you'd have to increase the revaluation reserve. You've revalued your non-current assets. Retained earnings, well, that is a measure of your profits. It's actually profit after tax. Taking your tax off, minus your dividends, and of course you know what dividends are. It's the share of the profits that you give out to your shareholders. Okay, so essentially, it's retained earnings is your profit. And if you're comparing that to a sole trader, you'd say, fine, I understand that, because in a sole trader, we have opening capital, we have capital introduced, we don't have anything like a revaluation reserve, but we have retained earnings as well, and that's pretty much net profit. And one thing you notice here, we don't have drawings. Okay, but it is very similar to that of a sole trader if you think about it. Okay, we call this shareholders funds, that's a new term. You can still call it capital employed, by the way. Right, good. Now, before we move on to show you how we deal with issuing shares, let's just have a quick review of this as well. These are the statements of a typical limited company. Left-hand side is your income statement, right-hand side is your statement of financial position. You will have noticed already that most of the income statement is just like a sole trader. It starts changing about here. There, for a sole trader, profit from operations, we would call it net profit. Okay, for a limited company, we'll call it profit from operations. Then we take off interest charges. We call them finance charges. Very often they're for mortgages, bank loans, and especially for debentures, a specialised type of loan. That's basically interest. Now, you're not going to have time to copy this, by the way, so don't try. It's going to be recorded. You can copy it then, perhaps. Then we do profit before tax. Then we apply the tax. We take this figure off, of course. Then we're left with the final profit there. The statement of financial position, top half is pretty much the same. You've got your non-current assets. Current assets minus current liabilities gives you net current assets. Current assets minus current liabilities. Okay, that's easy enough. Then we add in, or we include, the non-current liabilities, mortgages, loans, and debentures. A new term for you, debentures on document 371. It's a specialised loan with a fixed repayment date and fixed interest. We take that off to get the net assets. Okay, so that's very, very familiar, just like a sole trader. Then we go to the equity section. The equity section, also known as capital and reserves, and that's what we just looked at a little while ago. Okay, we compared 1 year to the next and we saw the changes from 2019 up to 2020. So what happened in 1 year? Now, it's all good and well as looking at these figures, but we want to know the detail of how all this happened and what changed specifically by how much. So you can get some kind of idea here. You can get some kind of idea. But in the exam, you are required not just to prepare the bottom half of the statement of financial position, you are required to prepare it, but in a different format. Now, this is the format. It's called a SOCI table. Now, don't use that term with the examiners, SOCI table. It's just the way we say it, just for short. It's a SOCI table because, of course, statement of changes in equity. So this is a part of the financial accounts. It's not just the income statement and the statement of financial position. It is also the SOCI table that you'll be required to do. What is a SOCI table? It is simply a summary of the bottom half of the statement of financial position. And in fact, to convince yourself that it is, can you trace these figures to the SOCI table, please? I'll give you a minute just to do that to ensure that you understand what's going on here. I won't steer you in the right direction just yet because I think most students will find this quite straightforward. Okay, so that first line represents these figures. Okay, that's your starting position for this year being 31st December 2020. You open with these balances, and then in the middle of the table, you record all the changes that have taken place with some detail. Detail meaning showing what the money, how the money was raised, where it came from rather, a rights issue, share premium. Then you record the profit for the year. And by the way, this is very important that you get this in your head straight away, because the examiners will give you all kinds of information about profit. Because remember, profit, there are 4 different types of profit there. There's gross profit, there's profit from operations, there's profit before tax, there's profit after tax. If you remember this table as just profit, then you'd be thinking, oh, I can't remember which profit it was. It's profit after tax that you record there. Then you've got your dividends. You take your dividends off. Remember, that's paid out to your shareholders as a reward, or for them it's a source of income, of course. And then if you have a revaluation, your non-current assets, your buildings have gone up, you'd record it there. So you can see the reference, revaluation there, go down, go across, revaluation there. Dividends, go across. It doesn't say dividends there at the top because it's showing you what it's taken off and what it relates to. It relates to your profit, your retained earnings. You have to remember this table. Okay, so your opening balances, you can see them there. The detail, you can't see there, and this is the whole point. This table gives you more detail than you'd get in your final accounts. That's why this is actually a supplementary part of the final accounts, which you'll be required to do in the exam. Finally, you've all spotted by now, the end line are the closing balances for the current year. Okay, sometimes in exams you'll be required to do the bottom half of the statement of financial position, which is there. I'm just hovering over it. Alternatively, and usually, you'll be required to do the SOCI table, which is similar because you've got your opening closing balances, but then in the middle you've got the detail. Now that detail is what we're going to be dealing with now for the next couple of lessons. I will do something with you and then Darren will take it up. Okay, now if you haven't had time to copy bits and bats of that, don't worry, we're going to repeat the SOCI table several times until you're quite bored, not this lesson but over the next 3 or 4 lessons. And also you can check from the recording. Right, let me pull up another document now. Darren sent you a couple of documents. I think it's document 373 and 374. Before we do that, we're going to look at 372. Now you may not have 372. It is available on Moodle if you are quick enough to get it. If not, not to worry. It kind of repeats itself in document 373. I think that's why Darren may not have sent it. Correct me if I'm wrong. I don't think Darren looked at 372 lesson. Is that right? Have you looked at document 372 with Darren in lesson?
What is 372? Is that concept or to do with the limited companies?
No. It's to do with limited companies. So you started off with document 371, which was limited companies, and you also should be doing 372.
Yeah, no, now, I don't think you sent that to us. I've got 373 and 374, not 372.
Yeah, absolutely. That's my understanding as well, and that's what I saw from the emails. So we're going to look at 372 quickly, and then we'll look at issuing shares. Right, now, although you don't have this document, there's not a lot to it. And in fact, I've already covered some of it just by showing you the SOCI table. And you can see a very simple SOCI table there. Okay, let's have a look then. Right from the top then, a statement of equity. Now what we're saying there, that actually is the statement of changes in equity. Should really be headed as that. Right, we'll read it word for word. If we need to annotate it, we will. If you've got questions, please speak up. This statement is another way of representing or presenting an answer to show the changes to the capital and reserve section of the statement of financial position. When we're saying the capital and reserve section, we are of course talking about the equity, the bottom half. Okay, bottom half, and I'll put that as well. Again, you're not going to be able to copy these notes that quickly. Bottom half of statements of financial position. Oh, it says it there anyway. It makes it easier to show all of the workings so that changes made are clear and easy to understand. I've already demonstrated that. Okay, I showed you the opening balances, the closing balances, and the stuff that happened during the year in a big SOCI table. Here we're going to look at a very simple one. Right, so they're going through a quick example here. This is the equity section or capital and reserve section of the statement of financial position, same thing. They've simplified it. They've only got two things going on here. You've got your ordinary shares and you've got your retained earnings. Okay. We know retained earnings is basically a calculation amending net profit. Additional information, so this is what they might provide in the question. They might say during the year profits were made of 80,000, dividends were dished out to shareholders of 20,000, and corporation tax was 16,000. Okay, and from that they might say, right, you are required now to do the bottom half of a statement of financial position for the end of the year. This is your opening figures. This is what happened during the year, and now you're meant to present the final position after these changes. Let's have a look. Now, some of you will be quite confident with this. You could do this without me saying much. The answer actually is there. Okay, highlighted in yellow. That's the answer. And these are the workings. Okay, these are the workings. First of all, you've got to work out if ordinary shares have changed. There is no mention of ordinary shares. There's no mention of shares being sold, additional shares being sold to shareholders. Okay, so that can be ignored. That means the only figure that's going to change is this, the retained earnings. And in fact, all this information that's been provided relates to retained earnings. So you can see from the working, what we do is we take the profit that we've made this year, we take away the tax, that gives us profit after tax. Another name for that is profit attributable to equity holders. In other words, what's available after tax to the shareholders, 64,000. Now, all of this could be given out as dividends, but of course, companies want to retain some of the profit. Hence, we use this term retained earnings, yeah? We take off the dividends, which the board of directors will decide. They'll say a certain pence per share will be distributed to shareholders. They've decided £20,000. Okay, so we've got retained earnings at the start of the period. Where do we get that from? There. We add the profit, but that profit is profit after tax, which is that profit after tax. So that's where you get the 64 from. The 20 was given in the question as well. Take the 20 off. We've ended up with a final 144. We started off with 100,000 and it's changed by 44,000. And then this is the final answer. Okay, we're presenting the capital and reserves. That was our opening position. Opening position in pretty pink and closing position in yellow. Now, that's one way of presenting the bottom half of the statement of financial position. But as I said, in exams, that's not going to be good enough. They want you to show the starting position, the end position, and what happened during the year. So those workings that you've got there, essentially, you've got to summarize them in the table. Now, the first time you're doing this, it's going to look complex. It's going to look a little bit complex. It's not, though. It really isn't. Especially now that I've shown you the example right at the start. You put your opening figures there for ordinary shares and retained earnings. You can have another column. In fact, In exams, sometimes they have it, sometimes they don't. They have another column to the right, and that's just like a total column. So I would like you now to copy this table, please. Copy this table. Don't copy the figures. Okay, you're going to have that document. You can download it later on. Just copy this table and then transfer. Well, I'm going to color code it for those people that are kind of stumped at the moment. But I'm thinking quite a few of you will be confident with this. So I'm going to color code it a little bit. Right, so I've given you a start there by color coding it. Your table has been set up for you. Could you have a go at putting the figures in? Okay, I'll give you 3 minutes for that. Okay, I know some of you are very quick in this route. Now, once you're done, I'd like you to take a picture of this and send it in the chat.
Sir,
Yeah.
you know, ordinary shares, you know how you go like tax and ordinary shares? What you write in that box, do you write the ordinary shares after taking away the tax from it? So like, for example, you get the profit and then you get...
Yeah, I mean, you can see that ordinary shares haven't changed. It was £200,000 at the start. At the end, it's £200,000. So you don't take the profit off that. You're talking about the total column, maybe?
Yeah, what do you do in that? Like, do you just write, let's say, for example, you do the retained earning at the start, and then for you to calculate the total of your profit, would you say like...
The shares don't affect the profit. I think that's the short answer. So I'm going to start developing my answer here. And those students that were confident enough to do this themselves, good on you. If you haven't, then let's... I thought I'd had the answers in there. Let's put them in. Ordinary shares, we started off with 200,000. Oh, they are there. 1 sec. some weird formatting going on here with the colours, so I need to just amend things. That's your starting position in pink. Can't go wrong really. 200,000 ordinary shares, retained earnings at 100. Overall, the value of the company, the shareholders' funds or the net assets, 300,000. Then you look at what happened during the year. Net profit is the same as profit from operations. You put that under retained earnings because it's got nothing to do with ordinary shares, it's to do with retained earnings. Retained earnings is a calculation adjusting the net profit essentially. It's an accumulated profit after tax and dividends. So we've got 80,000. Again, that's not showing for me. And we may as well do this total column as well. You just add across. There's nothing to add there. It's that same figure. It's just 80,000. Sorry if there's a bit of an echo, guys. I've got my phone on, but I have turned the mic off, but it's still echoing a little bit. Then we go to tax. Tax has nothing to do, so I'm going to say not applicable. I'll say not applicable there as well. It's annoying to have blank boxes saying nothing. Then we move on to retain. Does tax affect the profits? Well, of course it does. We take it off. Now, because it's a negative figure, can we put it in brackets? Add it across. Well, there's only one figure there. Ordinarily, there's 2 or 3 numbers that you need to sum across. In this case, it's a simple example. Dividends doesn't affect ordinary shares. The amount remains the same. Dividends we are taking off, so it's 20,000. And I'm sure some of you did this yourselves. And then we sum down, and it should represent the yellow figures really. 200,000. If we sum down, you can double check on your calculator. It should give us 144, and that is the total summing across. Just to double check with your calculators, if you sum down, you should get 344. If you sum across, you should also get 344. Can one or two of you verify that? Let's just check the figures.
Yeah, right.
Brilliant. Thank you very much. Okay. Right, I'm hoping you've understood. Are there any questions at this stage? Any curious little things that are niggling you? It may just be a case of getting familiar with this by practicing questions. There is more to it than that. In fact, we're going to start looking at how ordinary shares, how these figures are going to change. Okay, we had not applicable for all of them because tax, net profit and dividends has got nothing to do with ordinary shares. We're going to look at a more complicated table now. So that's document 372. Even though you haven't got it, you've copied this table out, you've got the idea of it hopefully, and you've got the video to refer back to as well. Okay, now we're going to move on to document 373, issuing shares. If you're doing your preparation properly, you would have looked at document 373 already. You would have understood bits of it. Some bits you won't be too sure about. Okay, I'm only dealing with rights issue this lesson. Darren will pick up bonus issues. And I want you to annotate this as well. It's a good document, but of course, for clarity, we can add a little bits. Right, so occasionally a limited company may wish to release additional shares. I don't really like the idea that they've used the word release there. I'm going to leave it there, it's fine. But what they actually do is they sell additional shares. So they invite prospective investors, which become shareholders, to say, do you want to buy some shares? Or they ask their existing shareholders, usually, they say, do you want to buy some shares? And if they do, they're selling them, which loosely you could say release. Release more applies more actually to bonus shares, but we'll leave that for now. So they sell additional shares. Two such ways of doing so are the bonus and the rights issue. Which one it chooses, it will depend on the aims and objectives of the company. As I've said, Darren will do bonus issue with you. Questions will require you to calculate the bonus and the rights issue and show the effect they have on the statement of financial position. And, can you write this down? And the SOCI table. Okay, I'll just highlight what I've just added to that and the SOCI table. And of course, if it's annoying you where it says balance sheet, we should really be using the correct term, statement of financial position. Although balance sheet is the correct term, it's an old term, isn't it? We're aware of that. Before we proceed, actually, could you add a little bit here as well? You might have to put a little arrow. So occasionally a limited company may wish to sell additional shares in order to expand. Okay, usually it's in order to expand. There could be other reasons, but let's just say it's more about expansion. Again, I will highlight what I've added. In order to expand. Let's move down then. A rights issue. All right, try to follow this example. We're going to fill in loads of blanks. Let's just get familiar with what we see first of all. We have a statement of financial position. It is, of course, summarized. You've got non-current assets. Again, annoyingly, we've got the old term there, non-current assets. Annotate your work, please. Not been able to print this document, it's going to be very annoying for you. I understand, and apologies. So we've got non-current assets and we've got net current assets. Now we know net current assets, so this is a bit of revision as well. It's current assets minus current liabilities. One thing that's missing there that would be applicable to most limited companies is non-current liabilities as well. Your mortgage, your bank loans, etc. But we'll leave it at that for now. So that's your top half. Does it equal the bottom half? That's the first thing you should check, really. And of course it does. Just highlight that, just to identify and make sure you understand that. Top half, bottom half. The bottom half, well, we know there's another name there. So for revision purpose, let's put equity. Now, in this example, they've got ordinary shares, share premium, and revaluation reserve and retained earnings. You can have a couple more categories there. For example, general reserve is one that comes up, but for now, let's just stick to those. Right. What's the nominal value of shares, first of all? What's the nominal value? This is important for our calculations going forward. So this is a question to you guys out there. Alex, the call ended because I have some Wi-Fi issues. Okay, Alex, you might have to, well, if you can hear me, you'll have to go for the recording. The first question then on this, what is the nominal value of shares?
Is it the first number you use on your The first number the company uses on their to value their
Brilliant.
ordinary shares.
That's it. That's it, exactly. When the company starts, they issue the shares at 50p each. After that, of course, it becomes the market value, because as time goes along, people are buying and selling, buying and selling, buying and selling. It changes the value. Okay, but that nominal value is very important. You can only include 50p in there, i.e. if you sell 100 shares, you times it by 50p. If you sell 1,000,000 shares, you times it by 50p. Even if you've sold them for 70p. In fact, this example is 70p. Right, let's have a look then. A rights issue on a basis of 1 for 4 at a price of 70. Okay, what the hell does that mean, first of all? Well, let's go back to this. A rights issue, this is when the company sells shares to the existing shareholders. They are usually offered on a ratio of the number of the shares held. For example, a 1 for 2 issue means that for every 2 shares held by the investor, they have an option to buy an extra 1. Makes sense. The shares are usually sold at a higher price or price higher than the nominal value, but at a discount to the current market price. Why would they discount them? Because they're selling to existing shareholders. So it's kind of a bonus to them, isn't it? It is a quick and easy way for the company to raise additional capital. And that's another reason why they sell them slightly less than the market value, because they're encouraging existing shareholders. They're enticing them with an attractive price. The market price might be 80p, but they've decided to sell them at 70p. How much were they when the company started off? 50p. Right, let's get through this then. The first thing to do is work out, by the way, I'm here. The first thing to do is work out how many additional shares are to be issued. Here we can see that they are going to release. Okay, now we need to do a calculation here. Let's first of all just put the figures in. Any idea what we're going to put there? This is not the calculation just yet, it's just the information again. Something additional share for every...
So.
Not sell. Should be 1 additional share for every... That's your clue, guys. In fact, that's your answer. For every... What's the ratio? That's what we're saying. What's the ratio? Thank you. For every 4 already available. But how many are already available? Okay. We can see that the total value of ordinary shares issued is... That's the value of ordinary shares. So pop that in. How much they've raised by selling shares at 50p. Each share was 50p. Therefore, how many have been issued? How do you work this out? Let me just do that. If you've raised £50,000 from selling shares at 50p, how many shares must have you sold? How many shares is that, guys? Work it out for me, please.
100,000 in it.
Absolutely brilliant. Yeah, easy maths. 100,000 shares. That's how many shares are issued. Now that is super, super important, because without that figure, you're not going anywhere. They're saying you're selling them at 70p. They're saying you're selling them at 1 for 4. So how many additional shares are you going to sell? How many additional shares? The calculation for that, 1 divided by 4, because it says 1 for every 4, times by the existing number of shares. That means they're going to issue
25,000.
Brilliant, thank you. An additional 25,000 shares are going to be issued. Just make sure you can see where the figures came from. That's the ratio, 1 for 4. That's how many shares are already in circulation. Therefore, 1 for 4 times by 100,000 gives us 25,000 additional shares. Okay, if they sell 25,000 additional shares or issue them, how much additional capital will they raise? That's not rhetorical. You should be able to calculate that. How much are they selling them for? 70 pence. How many are they issuing? 25,000. Therefore, the capital raised is that. Oh, by the way, sorry, apologies. In that box, they want 25,000 first of all. They're breaking it down into a very simple way of doing it. How much we're selling them for? E. Therefore, by now you'd have worked out what the extra capital is. How much is the extra capital then?
17,500.
17,500.
Yeah.
Very much. Right, guys, make sure you know where these figures are coming from. I'll slow it down just a bit. Okay, so that's how much they have raised. I'd like you to write this bit down, please. If that's the amount of capital that they've raised, that's how much bank will increase by. So that's the top half of the statement of financial position. What about the bottom half of the financial position? Well, let's just replicate that information there first of all. Add the capital raised to current assets bank. So that's what we've just said there. Top half is going up by 17,500. Bottom half should also go up by 17,500. However, it's not as simple as that. It's not difficult, but it's not as simple as that. What you have to do is you have to split it between your ordinary shares and your share premium. Remember, your ordinary shares, you can only include 50p per share in there. Anything above 50p will go in the share premium. Now we know we sold them for 70p. So we're going to leave the 50p there, 50p times by the additional number of shares sold, and add it to that figure. And the share premium will be the 20p to make up the full 70 times by the number of shares sold. But we build it up slowly. Let's have a look. Let's fill the figures in. So we need to separate out the premium. The original cost of the shares were when we say the original, we're talking about the nominal. Some of these terms will be used in the exam. That's the baby word, really. So I'm going to put nominal there. Well, the nominal value of the shares were 50p, but the rights should be rights, by the way. Rights issue sold them for, how much did we sell them for?
70.
Good. What was the market price, by the way? This was to existing shareholders. What if you off the street decided to buy? Pardon?
80p.
That's a good guess. We don't actually know, but we can assume that it's going to be more than the 70p. So I'm happy with that answer. Yeah, more than 70p, which gives us a premium of. Now, this word premium is the difference between the nominal value and the price that we're selling the shares at. Of course, it's just 20p, isn't it? Okay, so we'll put it in brackets. Okay, 70 minus 50, 20 pence. Right, we still haven't split it between ordinary shares and share premium. We know we've raised 17,500. The top half of the balance sheet has gone up by that amount. The bottom half of the balance sheet needs to go up by the same amount. Okay, multiply the number of additional shares by the original price. Let's just follow this as a set of instructions. It's easy, isn't it? Additional shares, we did a calculation earlier. If you've forgotten, scroll back up. That's your additional shares, 25,000. So use that figure. Multiplied by the nominal value. Splitting it between the nominal value and the share premium. So that's 50p. How much does that give us? Yeah, 12,500. And of course, 12,500 is not the same as 17,500. We're short. Why we're short? Because we haven't done the premium. The premium will be the additional number of shares, which of course is 25,000, times by the premium, the difference between the nominal value and the price we've sold them at. We've already calculated at 20p. What does that give us?
$5K.
5K, brilliant. So now what we should say is increase in ordinary plus premium should equal 17,500. Okay, we know that it does. Ordinary share capital we worked out was 12,500. The share premium we've just worked out as 5K. Okay, it's got to equal to bank. Now, using all that information, we need to do a final statement of financial position. I'd like you to have a go at that yourselves first, please. I've taught you through a little bit, but not too much. The non-current assets, well, did they change? Does it mention anything about a revaluation? Does it mention that they've bought new non-current assets? Not at all. The only thing that's changed is they've issued shares at 70p. And we've done the calculations for them. The two calculations were the top half of the balance sheet, i.e. bank, would go up by 17,500. And we know the bottom half of the statement of financial position will go up by the same amount, but it will be split between ordinary shares going up by 12,500 and the share premium going up by 5,000. So that's our starting point. We're on 2 pages, unfortunately. I think I might cut and paste this. I'll copy it. Okay, now you can start putting your figures in. Now, don't wait for others to do this. Don't wait for me to do this. Start doing it yourselves, please. Right. I'll give you a minute to try and do that, please. You will know that you're right because the top half will equal the bottom half. And you get a nice warm glow if you get a nice warm glow if you get this right. Once you're done, could you let me know that the top half equals the bottom half? Then I'll reveal the answer. Now be brave, please. Have a go at this. Okay, no more than a minute, please. Well, it should be there or thereabouts, really. Okay, the figures are filled in for you. The totals are not done. At the very least, I'd like you to get these figures down and add the totals for the top half of the statement of financial position, compare them to the bottom half. Have we got it right?
Yeah, it looks right. Yes.
Brilliant, thank you very much. Right, guys, I don't really want to bang on about reminding you to be active and engaged and, you know, not just waiting for the answers. You learn very little if you do that. You can make mistakes, but that's not a big deal at all. Learn from your mistakes. Right, indeed, the top half does equal the bottom half, and the changes were as a result of a rights issue, selling shares to existing shareholders at a price above the nominal value but below the market value, which gives rise to an increase in bank, ordinary share capital and share premium. Now, of course, that's not all of it, is it? We've got to present that in a SOCI table, statement of changes in equity. Table's been set out for you. I'd like you to present that information in that table. So all the information is on the screen if you haven't been able to print this off. I'll even color code it for you. Okay, couldn't be any easier really. What I would like you to do though, some of you may have noticed this table doesn't show you a total line, total column rather. Now it doesn't have to, but it's a good way of checking that you've got your answer right, because you're going to add across and add down. And in some exams they have this column, some exams they don't. So record your start figures. Record the changes. You might not be confident about putting the figures in here, but anything that affects ordinary shares, the nominal value, remember, it's good to put 50p in there as a reminder, it's just to do with the 50p. In other words, it's to do with that 12,500. Oops, that's already in there, one sec. Okay, so 12,500 in there. The remainder, remember, the top half of the statement of financial position went up by 17,500. We've only recorded 12,500 there. We know that it's an additional 5,000. That was 20p, the premium, times by the additional shares. Now, do we have a revaluation at all? At the start, we had 20, so there's an error here, isn't there? Yeah, during the year, you're right, we didn't have one during the year, but I didn't include one at the start. So adding across 50, 60, 70, 80, 90, 100, that's correct. During the year, it didn't happen, so we could put not applicable. You don't have to put this, but again, it's annoying to have blank boxes. Just put a dash or not applicable. You've got to add those across. 17,500. And then add down for each of the columns. in this question, it doesn't even tell you how much profit they made, doesn't tell you the tax, doesn't tell you the dividends. So it's a very simple one. It's only really one change they're dealing with. It's color coded. And then, of course, if it's worked out, when you add down and you add across, it should give you the same figure, which is certainly not that. Right, can you just double check then? If you add across and write the total down, then add down and check that total, it should be the same. And please let me know, has that worked for you?
Yes, sir, it's right.
Yeah.
Brilliant. Okay, so I think what Darren will do next lesson is he will either go on to the bonus issue, although I think I might advise him it's probably better to go on to document 374 first and do a couple of questions on rights issues and then go back to bonus issue. Otherwise you forget all this, because this is a different way of doing it, completely different thing. Well, there are some similarities, but it's quite different. Okay, so next lesson, if you're going to do some pre-reading, can you look at document 374 and actually possibly even practice the first question? So I was hoping to do the first question in lesson, but taking a bit longer than I thought. Homework 374, question 1. Now you will have to go back through all the notes for this lesson to be able to do that question, because not only does it have a rights issue, it will have a revaluation and it will have information on your net profit, tax and dividends. Okay, so this question 1 is really stretching you. It's quite ambitious. If you're able to do it, that'd be absolutely fantastic. Darren will be pleased, obviously. You'll be extremely pleased. If not, don't worry too much. You know, Darren's starting point will be question 1. All right, guys, thank you for the interaction and the engagement and participation. Remember, with these documents, it's only really going to work if you're able to print them out. If it's very difficult to get them printed out, I'm not sure what I can do. I mean, I might put it to my manager that, you know, some students perhaps at the start of a week are allowed in to college to print, but I don't think that's going to happen. All right, guys, call it a day then. I've got the register sorted and I will speak to you next week. Thank you very much.
Goodbye, sir.
Bye-bye. See you now.
Bye, sir.
Bye, guys.